share with us here on Market Guru. We've got Chakri Lokapriya joining us this morning. Chakri, always a pleasure. Well, markets have been on a roll. Chakri, we've been talking about the kind of momentum that we've been seeing and whether or not it's healthy. What's your take?
Well, the markets are not expensive at this point because at this point in the cycle, valuations do not matter that much. Given the fact that we're trading off depressed earnings, it's trading at probably about 13-14 times FY18 earnings. So when earnings pick up, whenever earnings pick up, which is more in 2018 kind of a story, at that point in time, the valuations will not look expensive. So at this point in time, we're early stages of earnings recovery, so the markets are fine, and we need other factors now to take the market higher.
So is GST one of those factors?
Oh, indeed. Today is a big day, and we're all waiting. I think it starts later sometime today. And I think GST is clearly a big positive in the sense that it removes a plethora of taxes that this country has had. State taxes, central taxes, some on goods, some on manufacturing. But indeed, how it's going to be implemented is going to make a big difference in the sense, and the key is not an interest rate higher than, sorry, a tax rate higher than, say, 18%. The number higher than that will clearly be actually negative for the market.
Chakri, good morning. I'll leave the regulators to do what they want to do because it still has to go to half the states of this country to be ratified. I mean, all of them, but half have to. I wanted to come to what's happening in financial services, especially in NBFCs. What's your thought? Is this really something that's building up so that there can be a slew of IPOs because a lot of these private banks are going to need money? Or is there some other reason that these stocks are going up?
I think it's the reason why they're going up is because of a lack of credit availability, or the fact that PSU banks or even some of the private banks are not in a position to lend to various forms of credit. That is one. And the second is, if you do look at a trend which is beginning to emerge, is the lower end of like affordable housing, microfinancing. These are the areas in which the credit growth is really strong. As you go up the chain, if you're big ticket corporate loans, loan demand is very weak. Housing loans above the 25 lakh mark is very weak. So it's only the lower end of the spectrum which fits well with these microfinance, NBFC type of companies. And that's the reason where we are seeing these huge momentum in these companies.
Talking about the financial space in a little bit more detail, what's your take now? We started, of course, to see some of the big earnings out and so forth. We still have a little bit of pain, but do you feel that the worst is over? Or, I mean, if I were to put it differently, how much more of an upside do you see from these levels now for these counters?
Given our parentage, we subscribe to George Soros' philosophy of the worse the situation gets, the bigger the upside.
Right.
And the situation is bad for the financial services industry. Industry credit is at multi-year lows. Consumer demand, loan demand is there marginally. Infrastructure demand is loan demand is actually negative. And NPA slippages, which continue in this quarter, I think are likely to continue for another quarter or so. But given the valuations and given the cyclical recovery that would happen at some point over the next maybe a good year out, we think we should be buyers of financials at this point in time, especially the PSUs and some of the troubled banks. I mean, if you look at even private banks like ICICI and Axis at bad quarters, which because of higher slippages.
So I wanted to bring up a question, Chakri, that's not openly discussed, but we all know that state governments face massive leakages of sales tax because a lot of companies simply, if I may, find a way to find some lowly official and not pay what they have to pay. But the GST now makes it a little difficult to do all these kinds of tricks. So actually, some would say, on the flip side, this is negative for companies because for years they've been getting away, or maybe since independence, getting away with all kinds of schemes and not paying. And now you just don't have a choice because now basically you're on the same pipeline and it's connecting one to the next to the next. Could it be in the short term actually damaging to company bottom lines rather than helping? Just given the reality of the Indian situation on the ground.
I think you raised several interesting points. One about the leakages. Yes, the GST replaces a number of complex taxes, center and state taxes into a single tax rate. But mind you, even the new GST that we're talking about still has a center GST and a state GST. And still states have power in determining what will be the GST rate for certain goods and services that is attributable to their state. But it reduces complexity. And for organizations in general, there will always be bad apples. Let's say 80% want to comply, 20% will always be there or the bad apples. So largely it increases tax compliance, more tax revenues for the government as a result. It increases the overall tax pie. And as a result, you know, your fiscal deficits and all those good things will improve in this country over time. But in the process leading to that, because I think for the next 2 years, there's going to be a lot of implementation uncertainty. And you rightly said, in that process, it will have an inflationary effect as well.
Chakri, you were chatting a little bit earlier, and you were talking about how some of the sectors have been impacted with regulations. And I mean, is that a clear no-no according to you? Would you stay away from some of those sectors? I mean, in the past, you know, certain sectors that we used to have under the regulatory spell are now actually doing really well in terms of momentum. You know, commodities, for example, you know, one of the pockets there. But today we've got pharma that seems to be in a constant churn, for example, just you know, to take one of the names there. How do you deal with that uncertainty? Do you stay away altogether? Do you try and sort of, you know, invest a little bit more selectively in those pockets?
I think that that's a very interesting and valid point. You know, what's happening is it's less supposed to be more good governance and less government, but unintentionally in certain pockets. For instance, the diesel ban by Supreme Court has led to job losses in the automobile industry because they're producing far fewer diesel engines. And it's also had an indirect impact. If you own a car with a car number, an even car number, you can't take it out on odd days, and you can't go out shopping on those days. And it's actually hit sales of in malls, and sales have fallen in those during those diesel ban days by about 5%. So you are cutting down economic growth in this country by this ad hoc policies. On the other hand, you mentioned pharmaceuticals. Pharmaceuticals, the new government talking about price controls for various drug formulations. Again, putting price controls makes it unprofitable or less profitable to companies, and therefore, you know, their focus will shift towards exporting more of the stuff, and rather than trying to address the domestic market. So both the regulators have to need to think through the long-term implications before coming up with ad hoc and changing the rules of the game midway.
Chakri, on pharmaceuticals, you know, in power, the government always deals with power generation and power transmission. In pharmaceuticals, I've traveled through various small towns, and I see kids sitting in pharmacy shops and handing you medicines, and there's a license out there, and there's absolutely no pharmacist there for miles to see. But I see no regulation, because the problem in pharmaceutical to me seems more the distribution than the manufacturing, because you just got Tom, Dick and Harry selling this stuff, and there's absolutely nothing you can do about it.
Yes, you're absolutely right. And I think some of that will take time. I mean, there is no easy fix in this country. And you need to have some kind of a regulation of how you distribute. And I think that will happen when you have companies such as Apollo Hospitals starting a pharmacy chain, and a bunch of these IPOs, where you're getting like the laboratory companies, diagnostic companies, etc. And all these companies now, given that they have public limited listed companies, there is greater accountability. Right. And pharmacies will have greater accountability going forward as they move away from a mom and pop operation, which is what they largely are today, into corporate organizations tomorrow.
Okay, I'm going to come back and explore that with you further in a moment, Chakri. Just pulling up some of the losers in the index. There's a bit of pressure being exerted there today. Just pull up the Nifty and Sensex. Power Grid is now down 2%, ITC 2%, Aurobindo Pharma, BPCL, HDFC, some of the names there. TCS and RIL and Infi, those are the three heavy ones, all down about 1%. It's interesting. We've got, for example, a couple of these that are just cooling off. So AZ, Oro, ITC, for instance, Power Grid even, there have been stocks that have been moving off and on lately, so now cooling off slightly. It's very interesting to see a reaction on a TCS and Infi on a day when HCL Tech has outperformed. Yesterday, in fact, we'd seen some of the defensives stand out and trade and managed to hold forth, but today a reversal coming in there. So a complete, completely opposite reaction coming in on some of those other IT heavyweights this morning. I'm going to get your take on that, Chakri, because we had, just to switch track for a moment, we had HCL Tech numbers come in and positively surprised, better than anything else we've seen in that pocket until now. How are you viewing, for example, the fact that one of these companies has managed to perform in an otherwise uncertain environment?
I think IT industry has two issues, one short-term and one long-term. The short-term issue is the Brexit, which, there was a shotgun reaction amongst banks in the UK and in the Europe of what do they do with their IT discretionary spend. And so they they slowed down giving out potential orders. This led to some kind of discomfort with the IT company bosses, and they cut their revenue guidance going forward. So simply not because Brexit is a reality, but because of the uncertainty what it will do to IT discretionary spend. The second thing, which is more a longer term story, is one you had mentioned about HCL Technologies, which is more it takes out people from, it reduces the cost for companies by transferring some of the manpower into its organization. Those kind of companies will actually stand a cycle better. But more importantly, I think, in the case of IT companies, you have the pyramid. The lower end of the pyramid, there is increasing. Computers are replacing human beings to do the same jobs. And so your value add is at the higher end of the pyramid. So, and this is just purely in terms of when you look at margins. A US software company has gross margins of 85% plus. Indian IT services companies have nowhere close to those numbers. So unless these companies figure out how to reinvent themselves to move up the value chain in terms of the services that they offer, and which is what Infosys and various companies are attempting to do, we will have a gradual the growth rates will stabilize simply because there will be some amount of IT spending anyway, but not the growth story that they were 10 years ago.
Chakri, you brought up a very interesting point, and if we are in a time wrap, and I sometimes go back and just look at same statements being made about railroads at a particular time, then about the Edison Electric Company at a particular time. They all seem like these amazing IT companies, but at the end of the day, they turn into commoditized businesses. What I wanted to ask you, Chakri, these stocks seem to be still being valued like they've just discovered something new, and a lot of them have actually turned utility and commoditized. I mean, at the end of the day, I don't know if Infosys hires 2 lakh people. I mean, it sounds like the Indian Railways. So, just because they have more dog and pony shows and more pomp and glamour doesn't change the commoditized nature of the business. Is it necessary, Chakri, that they need to structurally adjust in stock prices, and that's what's happening?
Interesting observations. If you look at the valuations, they're probably trading at about 14, 15, 16 times depending on the company. The earnings growth rate is more or less in line. So you're paying, let's say, even from a short-term perspective, in line with their growth. So let us say that the Con Edison type of a story does happen over time, and earnings growth slows down. At that point in time, we will see some derating. So the point well taken. But all these guys are attempting to go up the value chain. So you'll give them, the market will give them the benefit of doubt. Multiples will maintain short term.
Right. And that brings me again to the comparison of railroads, because railroads made Mr. JP Morgan and made most of the United States. And at one time, there were almost 500 railroads, maybe even 700. Some railroads running next to each other. And while railroads have survived, but maybe there are 2 major railroads in the US and the rest of it are all gone. Okay, maybe the Infosys has survived, maybe the TCS. Sometimes, Chakri, I fail to find relevance of the other 40 companies listed or 50 companies listed. Either they need to merge or their reason for existence is over.
Yes, life finds a way out, I guess, in the sense that one, short term you are seeing that what you mentioned, mid-cap companies, greater commoditization, lower PE multiples. They all trade about 7-8 times. And there will be mergers and stuff like that. Second, you have companies going into developing applications, apps, trying to do new things. So those will do out well. And the cycles, the 7-year itch kind of a story plays out well in an IT industry. Every 7 years, the technologies change with such rapidity that it makes redundant a whole bunch of skills. And that is what is happening to an extent in the IT industry, because you have automation replacing the lower skilled employees, and employees either have to reskill themselves, move up the chain, and companies also have to find ways of delivering higher value services.
Okay, I want to talk about industrials as well, and what you feel one should be doing with them right now, because cycle still hasn't completely turned, signs of it perhaps. I don't know what you're thinking.
The industrials, private industrials, two stories. One is government infra, all the roads, bridges, infra work that needs to be done. That infra will happen. There is a pickup, will happen. EPC companies will benefit. And in terms of capex of industrials, because they're operating at low capacity utilizations of 60 to 70%, as the economy improves over, let's say, the next year or two, from one shift, factory shift, they'll move to 2 factory shifts, then to 3 factory shifts. So yes, which means new job creation will be there. You have 1 factory shift, then you have a second and the third, so they have to hire. But will they build a new factory? No. So new capex is unlikely to happen. Which means it's actually a good thing from a stock market perspective, because the profitability, the profit margins of these companies will increase as capacity utilizations increase. And therefore, that provides another impetus or leg for the industrials valuations.
Chakri, of course, many of us don't have the size to question why a company does something, but you do have from a capital perspective. There are 2 things I'm seeing. Of course, there is a set of companies that are so debt-ridden that they obviously can't pay you anything. But there are many companies that are sitting with cash, but not sitting with ideas. And a lot of the IT companies have gazillions of cash. And then you have some companies that have cash, but like to get into businesses that they don't understand anything about. Just because cash is coming out, so, let me get into retail, let me do, FMCG, great, let's get into FMCG. Finance, let's get into finance. I want to ask you, as an investor, what are you doing? Because my point is that if you don't have any need of that money, please return it. And if you are something and you think your core business is over, well, there's no reason for you to get into other stuff. Give me the money back. What actions are you taking as an institutional investor? Because the guys who have cash are not giving it back to minority shareholders.
Interesting points. I think we are seeing a trend generally in terms of this move away from a conglomerate kind of a stand to a more standalone companies, standalone businesses. And if you look at several holding companies, they have a bunch of unrelated businesses. They all trade at 40, 50, 30, 40% discount to their peer group valuations of similar businesses. So that holding company discount is a way of reminding the promoter or the owner of the company that, look, your capital is not, there is a discount that you're being punished for. And the more progressive entrepreneurs do something about it. The others, they don't. And then you just exit the investment and walk away. On the other hand, what is happening is an interesting trend. Just to deviate, but again connected to what you say, you look at power industry. There's so much money was thrown at power utilities. Many companies in bad shape. Lanco, for example, they built some 40,000 megawatts. They have some 40,000 crores worth of debt sitting. And now a new company, I think it's called OPG Power, they've come and buying out all the, the unfinished, semi-completed power factories, utility thermal factories. So they're buying them at a far lower valuation than they were erected a few years ago. So I think you'll see more of this happening as the new players will come and clean up. So it would be, our endeavor to identify the more progressive guys and back them in helping up cleaning up this mess.
What are you making of the global environment currently, Chakri? Any kind of risks that you see there? I mean, which part of the world are you most sensitive to at this point?
The US at this point in time is doing really well. Even if you look at the latest data, both US incomes as well as consumer spending is up. And second, after oil went up to $50 and again has come down to $40-odd, so as oil has fallen another 20% recently. So which means inflation in the US is not there, and therefore there is no need for a Fed to hike interest rates other than Brexit and other factors. And so we think today that the Fed hike is a 2017 story, not 2016, which is good for India because it's still the largest trade partner for India. And other countries, yes, Brexit is eventually a problem, but initially pockets like IT companies, they will have issues. And overall, I think if the US still remains the main growth engine, China is slowing down, has slowed down, will find a way to fix itself out. But focusing on the domestic stories is what we are doing at this point in time.
Chakri, one last thought. You can look at it whichever way you want it, but I'm just wondering if the dollar will continue to appreciate if we have a major global crisis, irrespective of Trump. Some people thought that Trump's comments are this way or that way, but what I read in all this is a nation that actually opposed. I haven't seen many businessmen around the world who can say stuff against somebody who may become a potential president. But, right from Warren Buffett downwards, there has been complete outrage of what Trump says. For investors, actually, that shows that it's a safe haven currency, that don't even say their own president. Something I haven't seen many countries. They can call themselves democracies, communists or whatever, they never do it. But here, that whole country stood up and said, no, you're wrong. And would that kind of establish the fact that it will continue to remain a safe haven, and maybe the dollar will continue to appreciate irrespective of what happens if risk increases around the world?
You're absolutely right. US will continue to be a safe haven. In fact, that's reflected in multiples. If you look at a US company on aggregate levels, its PE's multiples are higher than UK multiples, which is higher than EU multiples, which are higher than emerging market multiples. So that's in a way of measuring risk, is you award the highest PE multiple for the most stable nation. And from an Indian perspective, like you said, this political discipline, or in aggregate, the whole country's discipline is very important. For India, for 2017, has to maintain its fiscal deficit of 3.5%, and that inflation targeting about whatever 4 to 6%. Those are key for Indian rupee not to depreciate further versus the US dollar.